Hey everyone, welcome to The Explainer. Today, we are unpacking a fascinating and honestly kind of terrifying financial domino effect. We're looking at a wild story where the explosive rise of artificial intelligence literally collides with everyday retail investors and a massive, usually hidden corner of Wall Street. So let's just get right into it.
Part 1. The Panic on Park Avenue.
Okay, I want you to picture this. It's February 23rd, 2026. A massive blizzard is just absolutely hammering New York City. Doug Ostrover, the co-founder of this financial behemoth called Blue Owl, is literally fighting his way through the snow to get to his Park Avenue office. And why? Well, because he has to lead a high-stakes emergency conference call. On the other end of the line, thousands of panicked financial advisors. You think these are the exact people who sold Blue Owl funds to everyday clients. And suddenly, those clients are trapped, and they are demanding answers.
So Ostrover gets on the line, right? And he tries to calm the storm. He tells them, I've been through many of these cycles. He is desperately trying to project strength here, trying to reassure all these advisors that the underlying investments are totally fine. But the thing is, the panic, it's already spreading like wildfire.
So what does this all mean? How exactly did an unexpected technological leap, like artificial intelligence, end up completely fracturing a tightly controlled $1.8 trillion private lending market? Well, to really answer that, we have to look at how this massive empire was built in the very first place.
Which brings us to Part 2, Building a Lending Empire. Now, the absolute bedrock of Blue Owl's success was something called direct lending. Here's how it works. Rather than mid-sized private companies going to your traditional Wall Street bank for a loan, they just bypassed them entirely. They borrowed directly from firms like Blue Owl. So Blue Owl stepped right into this incredibly lucrative gap, handing out these massive loans to private equity-backed companies, and, as you'd expect, they charged quite handsomely for it. And honestly, this strategy worked brilliantly for them. Let's look at the timeline. In 2016, Owl Rock, which is one of Blue Owl's original halves, is founded. Flash forward to December 2020, they merged with Dial Capital to officially form Blue Owl. By May 2021, they go public, and by January 2025, they were an absolute juggernaut. Their stock hit an all-time high of $26.73, soaring 65% in just a single year. I mean, they looked literally unstoppable.
By early 2026, Blue Owl was managing over $300 billion. Let that number just sink in for a second. $300 billion. Their revenue was naturally climbing into the billions, and they were the undisputed kings of the direct lending space. But, and this is a big but, beneath that massive number, a really dangerous structural flaw was quietly taking shape.
Part 3. The Dangerous Liquidity Promise.
Now, historically, direct lending was pretty much exclusively for patient institutional investors. We're talking massive pension funds and university endowments, the kind of groups that can just lock their money up for a decade and never expect to pull it out quickly. But to keep growing at that breakneck pace, Blue Owl needed new cash. So they started aggressively courting retail investors. Regular people. People who check their portfolios on their phones every single day and who definitely get nervous the minute the market wobbles.
But here's the catch. To actually get those retail investors on board, Blue Owl had to make a big promise. They told them, hey, you can withdraw your money every 3 months. The reality, though, those underlying loans sitting in the fund were highly illiquid. They don't just trade on a public stock exchange. Finding a buyer for complex, customized private loans can literally take months. So they basically promised quick exits on inherently slow-moving assets. It's a system that works beautifully, right up until the exact moment everyone wants out at the same time.
And that takes us to Part 4, the unforeseen AI shockwave.
Take a look at this. In Blue Owl's technology lending fund, a staggering 46% of their assets were tied up in loans specifically to software companies. Why? Well, private equity firms loved loading these companies up with debt because software subscriptions usually provide beautifully predictable recurring cash flow. Blue Owl absolutely loved making those seemingly safe bets.
But then, the artificial intelligence boom really accelerated. All of a sudden, AI started automating the exact tasks that those expensive software subscriptions were meant to handle. So companies began canceling their software packages, and almost overnight, that rock-solid predictable subscription revenue just vanished. The sky-high valuations that were built entirely on those assumptions, they just started cracking under the massive weight of AI disruption.
And the impact was just rapid and brutal. By early 2026, 17% of technology loans in the US were suddenly trading at distressed levels.
To put that into perspective, just a few months prior, that number was only 9.5%. That is a massive, massive jump in a really short period. And worst of all for them, it was hitting the exact sector where Blue Owl was most heavily concentrated.
Part 5. Closing the exit door.
Now, as you can imagine, when those everyday retail investors saw the news about AI completely upending the tech sector, they got spooked. And what do nervous investors do? They ask for their money back. Across the entire direct lending industry, withdrawal requests absolutely skyrocketed. Check this out. They went from under $1 billion in the prior quarter to over $2.9 billion in the fourth quarter. That's a 200% jump. The floodgates basically just burst open, and Blue Owl's OBDC2 fund was directly in the crosshairs.
To survive this absolute run on the bank, Blue Owl had to take some really drastic measures. Step 1, they tried to merge their private OBDC2 fund with a public one. The idea was that investors could just sell on the open market. But investors completely revolted at the terms, so Blue Owl had to scrap that plan entirely. Then came step 2. On February 18th, they were forced to sell $1.4 billion in loans to pension funds and insurance companies at a slight discount, literally just to scrape together enough cash. And then step 3, the one that really sent shockwaves through the market. They permanently ended quarterly withdrawals for the OBDC2 fund. Just like that, the exit door was slammed completely shut.
The financial fallout from this was nothing short of devastating. Blue Owl's stock plummeted roughly 60% from its peak just 13 months prior. Think about that. By locking down just that one single fund, they wiped $2.4 billion off their own market value in a single desperate move. And, when there's blood in the water, the sharks always arrive. Activist investors, firms like Saba Capital, they swooped right in, offering these trapped retail investors a really harsh deal. They basically said, look, we will buy your shares and give you cash right now, but you have to take a 35% loss. Ouch.
Part 6. A vulnerable trillion-dollar market. Now, when Blue Owl suddenly locked its doors, the entire $1.8 trillion private credit industry shuddered. The former CEO of PIMCO, Mohamed El-Erian, publicly asked, is this a canary in the coal mine moment? He was drawing a very deliberate, very scary comparison to the rumblings we saw right before the 2008 financial crisis. And guys, this matters to all of us. Because if this massive, mostly unregulated market just freezes up, it chokes off the capital supply to thousands of businesses. Politicians like Senator Elizabeth Warren immediately stepped in and started demanding stress tests and way more transparency in this previously unregulated private lending space. And the tension here? It wasn't just institutional. It was deeply, deeply personal for the executives involved. As the stock cratered, it was actually revealed that Blue Owl's co-founders had pledged $1.9 billion of their own company's shares as collateral for their personal loans. Now, as you can probably guess, when a stock drops 60%, those kinds of personal margin loans get very, very uncomfortable very fast. The sheer pressure on the leadership must have been unfathomable. Blue Owl built an absolute empire on this concept of permanent capital. But as this whole crazy story shows us, permanent really only lasts until people get scared. Wall Street took this highly specialized product, one that was designed purely for patient long-term investors, and they sold it to everyday people who expected quick, easy cash. And when a massive technological shift like AI spoke the market, the whole structure just cracked. So I'm going to leave you with this final thought. If the $1.8 trillion private credit market is truly this fragile the moment a few people run for the exits, what breaks next? Thanks so much for joining me for this explainer, and as always, keep learning.